half of 2019 has been rewarding for investors. In fact, it was the best first half of the year for the S&P 500 in more than 20 years. Now, believe it or not, some people think it should have been and will get even better. Why are some experts so optimistic? Well, in order to understand that, I need to revisit a little history with you. The strong market performance this year comes on the heels of a 20% drop in the market during the fourth quarter of 2018. In the past, after drops of such magnitude, the market's recovery was even stronger on average than what we've seen so far in 2019. That's why some people are expecting a rosy future going forward. Now, why has this recovery been subdued? Well, what may have kept the 2019 recovery modest could have been worries about trade wars with China and Mexico, and to a lesser degree, worries about interest rates. Now tensions around these issues seem to be receding, and that could give the U.S. market a boost. What specifically has changed with respect to trade disputes? Well, first, the threatened tariffs against Mexico were taken off the table in early June. And the trade negotiations with China have advanced as well. President Trump met with Chinese leaders recently and called for a temporary truce. He lifted the trade ban on some exports to China, and he promised not to impose additional tariffs at this time. Now, that outcome was far better than experts predicted, and positive surprises like these can sometimes help the market do very well over the short term. Is the Chinese trade conflict really over? Well, not at all. This is a truce, it's not a peace agreement. We don't know what might happen down the line. China hasn't committed to buying more American-made products, nor have they pledged to protect intellectual property rights, and those are two key American demands. Keep in mind that President Trump is holding off on more tariffs at this time. Who knows when his patience would run out and when the tariffs might spring back as a threat. Of course, I'm going to continue to monitor the situation and update you. The question is, should we change our investment strategy given these turn of events? Well, I don't think so. We're long-term investors, and long-term investors are usually better off when they ignore short-term news, good or bad. As optimistic as some market observers are right now, it's still impossible to know what the future has in store. Over the short run, the market may or may not react positively given the recent developments with China. And this is to say nothing of what happened last weekend with President Trump's surprise visit and meeting with North Korean leader. But we all know how quickly things can change. We had a stark example of that in May this year. After reporting progress on the Chinese-American trade talks, U.S. officials declared that China backed out on a number of promises they made earlier. And that threw the market into a tizzy almost overnight. Of course, it recovered quickly, but it was very volatile. So I don't think we should ever allow the news cycle to influence our long-term investments. Let's keep going. Let's talk about interest rates for a minute. In late 2018, the Fed chairman said he was reconsidering plans to increase interest rates. Now, that change in attitude helped fuel the 2019 market run-up. Now there's an expectation that rates could actually decline, and that could push the market up even more. We don't know. Will rates go down? Possibly. It depends on what happens with other economic data, which I'll discuss in a minute. If the trade dispute with China intensifies, or if the economy continues to slow, rates could drop. But even if interest rates do go down, that won't guarantee a strong stock market. It depends on the reasons behind the interest rate changes. And I'll talk more about that in future newsletters and videos. I want to talk with you about the economy. Most observers agree that the economy is slowing. Corporate earnings, new home sales, and consumer confidence have all dropped over the last few quarters. Now, that's one of the reasons why the Fed is considering reducing interest rates. Now, even though many important components of our economy are indeed slowing, it doesn't necessarily mean that the economy is in dire straits or that we're about ready to fall into a recession. GDP growth was 3% last year, and it will slow to 1.8% by 2021, according to the Federal Open Market Committee. Now, over those same years, unemployment is projected to edge up from 3.6 now to 3.8%. They project that inflation will rise from 1.5 now to 2% in 2021, and manufacturing is going to slow from 3.9 to 1.9 over that same period, according to their expectations. So the economy is slowing, but the economy isn't contracting over the short term. Some pundits refer to this as a Goldilocks economy, not too hot, not too cold, just perfect. If they're right, it could be really good news for investors. But again, we don't know what's going to happen. Only time will tell. In the meantime, I believe our current investment strategy is the right way to go. I don't recommend making any drastic changes right now. However, if your personal situation is changing, or if you have questions or concerns, get in touch so we can talk. It might make a lot of sense to reconfigure your portfolio. It depends on what's going on with you. Now, either way, I do look forward to hearing from you and being of service, and I wish you all the best. Thank you again.